The Bank of Japan is taking the long road out of its interest rate limbo. Governor Kazuo Ueda and his colleagues this week again tweaked monetary policy as the world's third largest economy edges its way back towards positive interest rates. They have good reasons to go slow. To the casual observer, the BOJ made few changes at its latest meeting, which wrapped up on Tuesday. The short-term interest rate remains negative, while the official target for the yield on 10-year Japanese government bonds is unchanged at 0%. The BOJ had also previously signalled that it would allow bond prices to fluctuate more widely. The main change this week was to describe a 1% yield on 10-year JGBs as an upper bound rather than a hard limit. These may seem like minor semantic shifts, but they matter in an economy which has grappled with the threat of deflation for a generation. Though prices are rising, the risk is that rate hikes spook consumers and businesses, and they increase the danger of financial accidents. Remember that Japanese banks, insurance companies and pension funds have not experienced sustained positive interest rates for over 2 decades. The downside is that Japanese interest rates remain much lower than in the rest of the developed world. Japanese yields have risen by half a percentage point since the beginning of the year and are now just under 1%, but equivalent US government bond yields have gained that much in just over a month and are now close to 5%. That means further pressure on the yen, which has weakened against the US dollar. Ueda and his colleagues are inching their way back to normal. The problem is that in the rest of the world, the definition of normal keeps shifting.